Bryan Rich from Money Markets TV. Over the past week, five central banks made important decisions on monetary policy and gave us clues about what to expect from their markets and economies going forward. First, there was another surprise rate hike out of China, its fifth in 7 months. The government there is concerned that runaway prices could spark social instability, sending the world's second largest economy into chaos. But China is also trying to mop up all the money that it poured into its economy, that money that drove double-digit growth while the rest of the world was slumping. The likely result here is a slowdown that will produce far weaker growth than other countries in the world are banking on for global recovery. Next up, it was the Reserve Bank of Australia. It held the line on interest rates for a sixth straight month following last year's campaign of rate hikes. Australia's policymakers are concerned that the impact of the December floods will hit growth and inflation readings coming down the pike. After Australia, it was Japan's turn. In response to the ongoing crisis in the country and strong downward pressure on the economy, the Bank of Japan has already promised to pump in another 5 trillion yen into circulation. And it will keep stimulating and taking whatever supportive actions are necessary. For that, my outlook for Japan is highly uncertain. On Thursday, the Bank of England held the line on its historic low interest rates and its quantitative easing program. Inflation in the UK is running high, but policymakers there reason that prices are likely to come down in the future without any tightening in monetary policy. That's because of a tax increase and the other tough austerity measures the government's imposed to rein in its worst budget deficit among major economies. Finally, we had the biggest rate decision of the week from the European Central Bank. Of course, Europe is in the midst of a widening debt crisis and desperate fight to save the monetary union from collapse. In Portugal, just became the third country in the Eurozone to admit that it needs a lifeline to avoid default. That's why the Eurozone is projected to be among the weakest of major economies this year. Moreover, the EU's strongest member, Germany, has a huge export-driven economy. And the recent global economic shocks will almost certainly take a toll on worldwide demand for its products. Nevertheless, the ECB became the first central bank in the developed world to begin rate hikes and move away from the ultra-accommodative monetary policy. Given the economic climate and given the solvency crisis among its own countries, given the spreading social unrest in the Middle East and North Africa, and the earthquake, tsunami, and nuclear crisis in Japan, it's a fair question, why would the ECB make such a move? It's because none of that matters to them. The only thing that matters to them is inflation. When inflation rises above the ECB's comfort zone of 2%, they tend to mechanically respond with rate hikes. It did the same in 2008 while the global financial system was unraveling and the Eurozone economy was entering into recession. And that move triggered a 22% collapse in the euro. This time, European policymakers could end up triggering the crisis they've been desperately trying to avoid, and that's the spread of insolvency to Spain. Just the talk about rate hikes leading up to the decision sent all government borrowing rates in Europe higher, including those in Spain. Now, an increase in the benchmark lending rate across the continent means that consumer loans and mortgages in Spain just ticked higher. And with an unemployment rate of over 20% and roughly 90% of all mortgages at variable rates, this could prove disastrous for Europe. Maybe that's why Moody's recently downgraded Spain's sovereign debt and 30 of its country's banks. Now, Greece, Ireland, and Portugal are already under the thumb of their European neighbors. Now, we have to consider Spain on the clock. So far, Europe's done a good job in avoiding economic catastrophe, but I'm not sure how long that's going to last. For Money Markets TV, I'm Bryan Rich. Thanks for watching.